The moment you have $250,000, everyone suddenly has a plan for it. Advisors, hot tips, the friend with a sure thing. But Jack is ignoring all of them. Today, he is putting that $250,000 into the 5 best Fidelity index funds on the market. And what if I told you this one boring decision could turn his money into something truly extraordinary? I am not talking about small gains. I am talking millions. In the end, I will show you a fund that could pay him over $64,000 a month in dividends, and another that could turn that $250,000 into more than $11 million. Picking 5 funds out of hundreds isn't about the biggest names or last year's hottest returns. Each earns its place differently. One leans on income, one on raw growth, one on defense when markets turn. Here are the 5, ranked from the smallest projected 30-year pile to the largest. We start with medicine. Fund number 5 is the Fidelity MSCI Healthcare Index ETF with ticker FHLC. It tracks an MSCI index representing the performance of the healthcare sector in the American stock market. That means drug makers, insurers, hospital operators, and the companies building medical devices all inside one wrapper. People fill prescriptions in booms and in recessions, which is the entire appeal. Demand for medicine does not check the business cycle before showing up. That steadiness is what Jack is really buying here. The fund holds roughly $3 billion and charges just 0.08% a year. The catch is concentration. This is one sector and the one Washington argues about most. New drug pricing rules, insurance reform, or a single failed blockbuster can drag the whole basket down. Jack's projection rests on 3 assumptions taken from early July 2026 data. A 1.29% dividend yield, dividends growing 8.77% yearly, and prices averaging 8.61%. On those inputs, his $250,000 would be valued at about $274,750 after 1 year. After 10 years, projections show around $643,110. After 20 years, $1,657,518. And after 30 years, the position is projected to reach $4,280,275. By then, dividends are projected at $52,597 a year, about $4,383 a month. Price growth would contribute $3,489,717, while reinvested dividends add $540,558. That is $4,030,275 projected on top of his original money. Notice the quiet engine too. The dividend grows faster than the price in this model, so income compounds ahead of the share value. Respectable, safe, and forgettable. The next fund is the one most American portfolios refuse to touch. In this ranking, that stubbornness is projected to cost them over $900,000. Fund number 4 opens with a confession most investors need to hear. Almost everything you own probably sits in a single country. The Fidelity Global ex-US Index Fund, with ticker FSGGX, owns most of the rest. It follows the MSCI All-Country World ex-USA Index, covering foreign developed and emerging stock markets. Emerging markets simply mean younger economies, like India or Brazil, still building their middle class. One purchase hands Jack thousands of companies his home market funds will never hold. Foreign companies often hand a bigger slice of profits back as dividends. That habit is why the yield leads this list. Now the twist that earns it this spot. FSGGX carries the highest starting dividend yield of our 5, yet it pays just once a year in December. The risks are real though. Currency swings can eat returns, and foreign markets have spent long stretches trailing American stocks. Jack is buying patience here, not excitement. And patience, it turns out, gets paid. A strong dollar alone can turn a good year abroad into a flat one at home. The parameter numbers here come from early July 2026. a 2.38% yield, 9.6% dividend growth, and 7.24% price growth. On those inputs, Jack's projected balance would be about $274,050 after 1 year. After 10 years, $641,904. After 20 years, about $1,755,326. After 30 years, the projection reaches $5,194,356. Annual dividends by then are projected at $217,011, or $18,084 a month. Here is the part worth studying. Price growth would add $3,199,097, but reinvested dividends would contribute $1,745,259, making a total value added to the portfolio of $4,944,356. That is roughly a third of the final pile, built from the weakest price assumption in this entire lineup. Time and reinvestment did what a hot market usually gets credit for. A high yield, reinvested for decades, quietly builds its own engine. Remember that mechanism, because the next fund is the most famous one in America, and fame only buys it third place. Fund number 3 needs no introduction, which is exactly why people misunderstand it. The Fidelity 500 Index Fund, with ticker FXAIX, simply buys the S&P 500. Those are America's 500 biggest public companies, weighted by their size. Size weighting just means the bigger the company, the bigger its slice of Jack's money. Investors have added roughly $828 billion to this one fund, and it remains one of the cheapest S&P 500 funds on the market. Before the numbers, one honest warning. If you skip ahead, the final fund's total will look like a typo. It only makes sense once you watch what the S&P 500 does with the same money first. So hold on for 2 more minutes. The risk hides inside the weighting. Because size decides each company's share, a handful of technology giants steer the entire index. When they stumble, Jack's whole $250,000 stumbles with them. Diversified across 500 names? Yes. Diversified across ideas? Less than you think. The same engine that lifts this fund concentrates its risk. Now the July 2026 numbers. A 1.04% yield, 6.41% dividend growth, and 11.28% price growth. On those inputs, Jack's projected value after 1 year is about $280,800. After 10 years, around $784,765. After 20 years, about $2,391,898. And after 30 years, projections show $7,160,790. Now look closely at the income line. Annual dividends by year 30 are projected at just $15,691, about $1,308 a month. Price growth would deliver $6,687,072, while reinvested dividends add only $223,717, adding a total projected value of $6,910,790. Price did nearly all the work. The dividends were pocket change. That is not a flaw. It is simply what this machine is built to do. This sets up the strangest result in this ranking. The next fund holds bonds, and bonds are supposed to slow you down. So how is it projected to finish $927,000 ahead of the S&P 500? Fund number 2 is the Fidelity Multi-Asset Index Fund, with ticker FFNOX, and it is a fund built from other funds. Roughly 41% sits in the 500 index and 24% in international stocks. 10% goes to smaller companies, 10% to emerging markets, and about 15% to bonds. A bond is simply a loan you make for steady interest. the slow lane of investing. One ticket buys Jack the entire playbook, rebalanced for him. This is the fun for someone who wants one decision, made once, and then decades of silence. Now the paradox from the intro. In this projection, the balanced fund beats the pure stock fund, and it wins on income. By year 30, FFNOX is projected to pay $776,000 a year. That averages out to roughly $64,700 a month, since it distributes twice a year. The remaining July 2026 inputs are a 1.81% yield, 13.61% dividend growth, and 7.07% price growth. On the full set, Jack's projected value after 1 year is about $272,200. After 10 years, around $620,495. After 20 years, about $1,872,762. After 30 years, the projection reaches $8,087,662. Annual dividends by then are projected at $776,661 yearly, or $64,722 monthly. Price growth would supply $3,690,664, while reinvested dividends contribute $4,146,998. More than half the final pile comes from reinvestment, making a total projected value added of $7,837,662. The bonds still apply their usual tax, cushioning crashes while capping the upside in strong years. In a crash, that cushion is the feature Jack will be grateful for. So, if FFNOX is the income machine, why is it not number one? Because the final fund is projected to add $3.1 million more. Fund number one hands Jack the biggest pile. It is the Fidelity MSCI Consumer Discretionary Index ETF, with ticker FDIS. It owns what Americans buy when they feel good about tomorrow: online shopping, cars, home improvement, restaurants, and travel. Amazon alone makes up about a quarter of the fund, with Tesla and Home Depot close behind. The top 10 names account for roughly 56% of the whole thing. This is a concentrated bet on the confident American consumer. When wallets open, these companies grow earnings faster than almost anyone. When wallets close, they feel it first. FDIS simply rides that cycle at full size. With a 0.72% yield, income is an afterthought here. The July 2026 numbers add 5.31% dividend growth and 13.23% price growth. On those inputs, Jack's projected value after 1 year is about $284,875. After 10 years, roughly $905,938. After 20 years, about $3,201,019. And after 30 years, projections show $11,185,691. Annual dividends by then would be just $6,495, about $541 a month. Price growth would deliver $10,824,109, with reinvested dividends adding $111,582. Making a total projected value added of $10,935,691. $250,000, and the lesson wasn't a secret ticker, it was mechanics. Know what does the work in your fund, price growth or reinvested dividends, and pick the one you can hold through every crash for 30 years. If you're leaning toward growth as your engine, watch highest performing ETFs for long-term gains next. It's where that 30-year mindset actually gets tested.